Investing. It's a word that often evokes images of Wall Street tycoons and complex financial jargon. But here's the truth. Building wealth through investing is not an exclusive club reserved for the wealthy. In fact, you can apply the same strategies used by seasoned investors to grow your own nest egg. The key is understanding their approach and adapting it to your circumstances. One of the most powerful tools in the arsenal of wealthy investors is the concept of compounding. Imagine a snowball rolling down a hill, gradually picking up more snow and growing larger. Compounding works similarly. When you reinvest your earnings, those earnings generate their own earnings over time. This snowball effect can lead to significant wealth accumulation, especially when you start early and remain invested for the long term. Another crucial aspect of wealth building is diversification. Rather than putting all their eggs in one basket, successful investors spread their money across a variety of asset classes, such as stocks, bonds, and real estate. This strategy helps mitigate risk. If one investment performs poorly, others can cushion the blow, ensuring a more stable and resilient portfolio. The good news is that you don't need to be a financial expert to emulate these strategies. By understanding the fundamental principles behind wealth creation and adopting a disciplined approach, you can pave your own path towards financial freedom. Remember, investing is a marathon, not a sprint. Patience, consistency, and a long-term perspective are your allies on this rewarding journey. The stock market can seem like a daunting and complex world, but it's actually much simpler than it appears. At its core, the stock market is simply a marketplace where buyers and sellers come together to trade ownership in publicly traded companies. These pieces of ownership are represented by stocks or shares. When you buy a share of stock, you're essentially buying a tiny slice of that company. If the company performs well, its value increases, and so does the value of your shares. Conversely, if the company's performance falters, the value of your shares may decline. It's a bit like owning a piece of a pie. As the pie grows or shrinks, so too does the value of your slice. But you don't have to pick and choose individual stocks to participate in the stock market. Index funds offer a simple and effective way to invest in a diversified basket of stocks, such as the FTSE 100, which tracks the performance of the 100 largest companies listed on the London Stock Exchange. This approach provides instant diversification and spreads your risk across a broader spectrum of investments. Understanding the basics of the stock market is crucial for any aspiring investor. By grasping these fundamental concepts, you'll be better equipped to navigate the world of investing and make informed decisions that align with your financial goals. Exchange-traded funds, or ETFs, have become increasingly popular in recent years, and for good reason. Think of ETFs as baskets of investments like stocks or bonds that are bundled together and traded on stock exchanges. They offer a convenient and cost-effective way to diversify your portfolio and gain exposure to a wide range of asset classes. One of the main advantages of ETFs is their simplicity. Instead of researching and selecting individual stocks, you can invest in an ETF that tracks a specific index, such as the FTSE 100 or the S&P 500. This means you're instantly invested in a diversified portfolio of companies, reducing your risk and simplifying your investment strategy. ETFs also tend to have lower fees compared to actively managed mutual funds. This is because they are passively managed, meaning they track an index rather than relying on a fund manager to pick and choose investments. Lower fees mean more of your money stays invested, potentially leading to higher returns over time. Whether you're just starting out or you're a seasoned investor, ETFs can be a valuable addition to your portfolio. Their simplicity, diversification benefits, and cost-effectiveness make them an attractive option for investors of all levels of experience. You don't need a fortune to start investing. In fact, you can begin building your investment portfolio with just £100. The key is to start small, stay consistent, and gradually increase your contributions over time. The first step is to choose a reputable online brokerage platform. Look for a platform that offers low fees, a user-friendly interface, and a good selection of investment options, including ETFs and index funds. Once you've opened an account and funded it with your initial £100, you're ready to start investing. Consider investing in a low-cost, diversified ETF that tracks a broad market index, such as the FTSE 100 or the S&P 500. This approach allows you to gain exposure to a wide range of companies with a single investment, spreading your risk and potentially maximizing your returns. As you gain more experience and increase your contributions, you can explore other investment options that align with your financial goals. Remember, the most important step is to simply start. Investing even small amounts of money regularly can make a significant difference over time, thanks to the power of compounding. By starting early and remaining committed to your financial goals, you can turn your pocket change into a substantial portfolio and secure your financial future. Please share if you found this useful and subscribe for more valuable information.